Back, it's a little quiet on the screen, and we've come a long way from the exuberance of the morning. Sanjay Dutt, director of Quantum Securities, is with us to take us through the impact and really what it means for the market. Sanjay, good morning. Thank you so much for taking this call. So, the market sold off fairly effortlessly after the opening pop. What did you make of the kind of announcements that we saw on Friday, and to what extent do they alleviate the pain?
See, I think more than the impact of the announcements in terms of real numbers, in terms of how they would impact the economy and obviously the resultant equity prices, isn't substantial. But what is more important is that they're a message to the markets that the government is listening and the government is, willing to take corrective steps. I think that is more important than the quantified benefits that may arise immediately. In any case, nothing can arise immediately. All these measures do take time to pan out. So whether it is the upfront 70,000 crores coming into banks and how it translates into lending or liquidity ahead, et cetera, et cetera. So, of course, the FPI issue is a sentiment issue in the sense that government corrected a wrong which the market and everyone thought was not the right thing to do, the FPI taxation issue. So it's more messaging, and job owning is what language that normally one uses in the markets. That's very positive than a quantified benefit, because there is no fiscal stimulus or anything to really be able to, change our forecast numbers or estimates as such.
Sanjay, the fact that we may see another set of announcements, as the finance minister indicated, will that keep hopes alive? At least, not force another big sell down till that comes through, or you think, it's anything's fair game now?
What I feel that what the fresh announcements have or don't have, one doesn't know, because still they don't come in, and how they translate into numbers, which I'm repeatedly saying. But what I think right now is that the very positive messaging that happened on Friday has at least put a floor to the markets. We are at attractive or fair value in a lot of pockets in the market. Whatever the overvaluation was has kind of got adjusted, unless we have some more real bad earnings coming in or downgrades coming in going ahead, and the outlook doesn't change. But as things stand right now, given what most companies have spoken and forecasted and shown numbers, I think we are at a fair or reasonable valuation, or in fact some pockets very attractive valuations. So therefore, to cut a long story short, we have a floor, I think, in place in the markets and in most stock prices. Now, how we build up on the gains or what the incremental gains come in ahead would take time. Obviously, the markets would consolidate, one would rework the numbers depending on what more announcements or measures come in.
Sanjay, obviously, the other piece that's been missing in this puzzle is durable earnings growth. Now, a lot of companies that we speak to say the same thing. Second half is going to be much better. Do you believe that's possible? Do you think these measures do anything to make that a reality?
Not necessarily these measures, but these measures do reinforce my belief. In fact, I spoke with Prashant and Lata a few days back, and which I've been saying for quite a few weeks actually, my hypothesis that stock prices ahead would appreciate, and markets would appreciate, is primarily based on the facts that I see an aggressive fall in the cost of capital going ahead. That, I think, is the single most important thing that will happen in our economy. We would see unseen levels in terms of cost of capital for a long time to come, what we've seen in the last 10 years. And cost of capital, bond yields have a direct bearing on equity prices. So therefore, and obviously they have a direct bearing on, performance of companies. No one can doubt the fact that inherent long-term demand in our country is intact. It hasn't got disrupted in any manner at this point of time. We could continue to have a debate on cyclical, structural slowdowns, so I don't want to go down that path. But I just understand simple, basic demand supply. I think demand is intact in our country. If cost of capital starts to come down for consumers, for industry, everything, I think the earning outlooks will change, and and therefore one can expect better equity market performance.
Sanjay, specifically with regards to autos, Maruti, I think is still up some 13-14% this month. So let's just take Maruti as an example for the auto sector. What would you do there? Do you think these are attractive enough levels, even if you have to wait a little longer?
I think these are reasonably attractive levels, and at every decline, a stock like Maruti should be brought. I don't think the problems or the woes that the auto sector is facing are going to go away very soon. But what I think is that most of the negatives in the foreseeable future, until something new and big is thrown at the sector in terms of negatives, I don't think the stocks would really correct any further. Maruti and these kind of companies will continue to enjoy a premium in the sector, premium in terms of valuations, and premium in terms of overall market. I have been bearish in the auto sector for about 2+ years, or more, maybe more also. And for the first time, I think about 4 or 5 weeks back, I was having a discussion with Sonia on your channel, along with, I think, Anuj. And Sonia obviously looks at the sector and is very knowledgeable on this. And it's the first time I said that auto companies can be looked at as an investment proposition in a portfolio for a 2 to 3 year perspective. So I think Maruti is a good bet to have in your portfolio. Of course, my disclaimer here would be I don't have it in my portfolio, but I think it's definitely should be accumulated on every decline as a long-term investment.
Okay. Sanjay, the other interesting trend that we picked up in the market over the last couple of weeks has been the way the market's looking at some private corporate banks. Look at what's happened in the case of RBL, for instance, or even the manner in which IndusInd has been struggling, largely because of the concern on the kind of exposure these banks have. This kind of a fall, should it be a buying opportunity and a dip that you buy in these banks, or is there a real threat and a real concern here?
I would start with the caveat that I've been wrong earlier on my calls in bank for the last 1.5 years. But I personally feel that banks like RBL, IndusInd, and this kind of family still have some problems. If you just look at the size of the books of banks like RBL, if you were to compare them with a lot of other public sector banks trading at much lower valuations, I think at this point of time, the risk reward, according to me, favors some of the PSU banks. But once again, I go back to say I've been wrong for 1.5 years, but I think it may be time to actually look at some real good tactical positions in select PSU banks who've kind of cleaned up their act. And I'm basing this on the hypothesis that I think governance issues in the banks, also public sector banks, are starting to be addressed in terms of management, quality of management, the recruitment processes, etc. So with this backdrop in mind, I wouldn't mind taking a risk with a reasonably good stop loss on PSU banks, and would want to avoid IndusInd and RBL, because the key issue with these banks, and in fact most of the financial services companies, including NBFC, is going to be liability side of the book and not the other side of the book. And with the liability side, most of these banks are going to face challenges as soon as risk aversion or conservative capital or normal capital turns into real conservative capital into protection mode. So normally people tend to rely more on PSU banks, and PSU banks are competitive valuation. So liability side is the biggest challenge for the financial services sector with NBFCs or banks. So in that sense, I think PSU banks are much better positioned today.
Sanjay, it's a pleasure. Thanks very much for joining us and running us through what you're making of things at this point in time. So Sanjay's point essentially being that maybe, just maybe, the announcements have put some kind of a floor for the market. It doesn't mean the market is going to do well, but a combination of what has been announced and the combination of what may come probably is going to keep bulls alive with hope. But hope is what is there at this point. 32-34 is what the Nifty's got. So prices across the board are off the highs. You look at the advanced decline ratio, 1,032 stocks are higher, 616 stocks are lower. So market breadth has also come off quite a bit. The gap is closed from the morning levels. Let's focus on commodities now. Manisha Gupta is joining in with all that is happening in the commodity and currency market. Manisha, morning.
And I bring hope.
And you bring hope.
I bring hope.
Are you talking about gold? Or?
I am definitely talking about gold. 6th day of all-time highs in gold, and we are 25% up in this year in case of gold prices. And of course,
why can't gold and stocks live together happily? Why does one have to be down?
When
for
you
the
have
other to be
stock
up?
market men asking, should we now buy gold? I think it's that's a headline. That's a headline. Yes, totally. So yes, the gold prices are continuing to gain up, and 39,000 is what we are trading above at this point in time. But as we've been discussing, there are various
serious concerns, the sell-off in global equities, the US and China trade dispute now intensifying, and the dovish statement that we heard from Powell at Jackson Hole. So I think all of that is contributing, and especially for the Indian markets, it is the Indian rupee as well, trading at 2019 lows, which is taking the gold prices on the higher side. Joining us is a very special guest today, Edward Morse of Citi, with his sense on where the gold prices could be going. Ed, hi, it's a pleasure to have you. 6-year highs on the gold prices, all-time highs in the Indian markets, and that's how we've seen gold make all-time highs in various other currencies as well. What is your sense on what's happening and where are we headed from here?
Absolutely. We think gold is responding to the risk factors in the environment and responding to where interest rates are going. We are in a period where central banks are easing on the rates side. We expect another 50 bips out of the U.S. Fed come September. So we think that as we've seen these rate cuts, in fact negative interest rates in Germany over the last week, we think this is going to be another signal for inflows into gold. And yes, the gold price has come off a bit, but inflows into gold ETFs have risen. China is lifting its restrictions on gold imports. India is opening a new gold exchange. And we think the investor appetite is there.
So, Ed, what is your sense then? What is your sense on where the gold prices are headed in this year and the next as well?
So we certainly see 1,600 as a targeted price for the end of the year. We're looking at 1,700 into the end of 2020. We're not as bold as some others, thinking we know what's going to happen to the world economy, but those who have a $2,000 price are really banking on effectively a recession, and we're not there yet. We think U.S. growth has been strong. The recent signs of PMIs in France and even Germany that have been relatively positive. We think the Chinese government has plenty of ammunition to prime the pump there, as they did both in 2009 and 2016. So we're not ready to say a recession is going to be there and there's going to be this flight into gold as a safe haven.
That's a lot of hope, actually. But Ed, as we see all-time highs in gold in the Indian markets today, we are trading at a 3-year highs for silver as well. When you look at the gold and silver ratio, do you think silver is now getting ready to outperform gold in the days to come?
Well, we're positive silver as well, and silver has gone up a bit, and the ratio between gold and silver should be lower than it currently is. So yeah, we think of the two, silver may be the better way to play it. Gold ETFs can be bought for a reasonable amount of money too. So we're positive both gold and silver, and we think the ratio or the price level is going to fall, meaning the higher silver prices relative to gold coming in through this year and next.
Ed, as you said, you are very bullish gold and silver this year and the next, but I'm going to just push you for the silver price target as well and what you are looking at in sense of silver by this year end.
Our silver target is 1850 by the end of the year.
I also want to talk about the base metals with you, and US and China, of course, is one side of it, and then you have the faltering Chinese economy. Markets also are looking at demand growth concerns now coming in, and we have seen a very sharp decline in almost all the base metal prices. Each one of them, barring nickel, is in the negative in 2019. How do you look at this year now, the rest of it for metals?
Oh, absolutely. There's a quite tight correlation between two things, one of which you mentioned, Chinese growth coming to now the low 6% level. We don't think the Chinese government's going to like something below the 6% level. They've already provided the right kind of credit to have a slow impact. They're increasing fixed asset investment, which we think should have a positive impact on copper. But I think you said something at the beginning of your question that really is what the question is. You said the U.S.-China trade war aside, and really in our mind the U.S.-China trade war is basically everything. If we're in a world of 2 to 3% trade growth, that's not going to be a world that's going to be sustaining demand for commodities overall. There needs to be some mechanism to get trade to grow again, to get investments globally to flow internationally. And there's where the politics between the U.S. and China really count far more than whatever the easing can be done through monetary policy by central banks.
So, Ed, when you said that you are expecting the markets to stabilize, especially with the kind of ammunition that many of the global central banks still hold, would you say metals in that sense are anywhere near bottom? Do you see a buying opportunity rising anywhere at all?
Not much. In copper, we would say 5,500 may be the bottom if it gets there. We think we're in looking at the metals. We look at the inventories in LME, on the SHFE. We look at what the cost curve is telling us, and the cost curves for most metals are telling us that the marginal demand for the marginal ton or the marginal molecule is going to be higher priced pretty soon because that's where the cost structure is. When you're seeing prices falling down to the marginal cost structure, that's what it takes to call a bottom.
Okay, all right, Edward, thank you for explaining that to us and giving us perspective on all the metals out there. Thank you for joining in. We will take a quick break on that note. On the other side, we will come back and discuss equity